Adjustable rate mortgages are a powerful way to lower your payments. They're frequently misunderstood, so I'd like to clarify some of the details so you can make a decision that's right for you. First, realize that many adjustable loans are fixed for certain time periods. Common periods are a month, 6 months, 1 year, 2 years, 3 years, 5 years, 7 years, and 10 years. Second, understand that the longer the bank has to commit to a given interest rate, the higher that rate is going to be. Banks don't know what the rates will be in the future. The shorter the fixed rate period, the less of a guess or the more accurate they will be. Ultimately, what the open market pays for these mortgage-backed securities determines their rates, and in general, is related to how much people want the investment. When you compare a typical 30-year fixed mortgage to a 1-month LIBOR, you can clearly see the premium some people pay for the security of having a fixed interest rate. When it comes to making a decision as to what program is best for you, we recommend the following considerations. Consideration 1 is how long you expect to own the property. If you're a first-time homebuyer, we invite you to consider these statistics. Americans move. The typical homeowner keeps their first property for an average of 2 to 4 years and moves up once or twice before getting that dream house in which you can really get comfortable and stay there for many years. If you'll own that house for just a few years, don't let banks trick you into taking the highest rate out there, the 30-year fixed mortgage. Consider getting a loan that is fixed for just 2, 3, or 5 years and save yourself many thousands in interest charges. If you go over the initial period, it's not a problem. It simply means your mortgage payment may vary somewhat up or down from month to month. Remember, you can refinance if you change your mind or, of course, sell the property. Consideration 2 is whether you'll qualify for a better loan within a few months or few years. This is usually due to one of the 3 C's, credit, capacity, or collateral. For example, if you have some credit issues you're still working on or a bankruptcy a year or 2 back, why be penalized for a long-term interest rate? Let's get you a good short-term option, and then when you can qualify for that top-shelf A-paper program, we'll get you the financing you want and deserve. In the case of collateral, if you're buying a home below market price or doing a lot of work to improve the property, this will increase the value of the collateral. As the property value increases, the risk of foreclosure goes down because the bank knows that's your money locked inside your home in the form of equity, and therefore you're more likely to make sure all the payments are made on time. Realize that even if a property appraises for $300,000, but you're buying it for $200,000 and borrowing all $200,000, this does not mean your loan-to-value is at 66%. The bank looks at it from a perspective of how much of your own cash is in the deal. Once you've owned the home for 6 months or a year, your loan-to-value calculations will be based on market value. When you buy a property expecting to spend money improving it, that may qualify you for a lower risk, aka better rate, program. When first considering an ARM, some of the numbers can be confusing, but are actually quite simple. A common example is a 5-1. This loan is fixed for the first 5 years and adjustable thereafter based on the previous 1 year. 5-1s are frequently mislabeled 5-6s or 5-25s, though they essentially function in the same way. They're both fixed for the first 5 years and after that adjust every 6 months or every month, respectively. All of these programs have caps, which is how the loan can adjust after the initial fixed period. A common cap is 262, which means the first adjustment can be up to 2 points in either direction, to a total of 6 points over the initial rate, and each successive adjustment thereafter can be up to 2 points as well. This may be overly detailed, but it's worth a mention if you think you may run over the initial term. These are never negotiable and are specific to each investor. Make sure not to confuse these loans with a balloon payment loan. A balloon is when the loan is due in full. For example, a 30-15 is a 30-year amortized loan that's due in full in 15 years. The loan must be paid off or refinanced prior to the end of that period or foreclosure will be filed. As a practical matter, most lenders do have extension clauses or would be happy to refinance that loan were it ever required. Over the last 20 years, the average mortgage was kept about 3.4 years. In a rising interest rate economy, this is likely to increase as people are more likely to get seconds and thirds and won't want to touch their first. Nonetheless, people's needs, situations, and even job locations are changing more than ever, and adjustable rate mortgages are here to stay.